Welcome, everyone. I'm Michelle Noyes, Head of Americas at AIMA, and I'm delighted to welcome you to today's webinar on portable alpha. The last time I hosted a program on this topic was 2007, so I'm excited to revisit how it has evolved and the drivers of current interest with John Caplis of Pivotal Path, Keith Friedman of GCM Grosvenor, Lauren Sholder of Winton, and Rodrigo Gordillo of Resolve Asset Management Global. While I have plenty of questions of my own to drive today's conversation, I also encourage everyone joining us live to ask questions using the Q&A tab. But we have a lot to cover, so let's just get into it. Starting with John, can I ask you to introduce yourself and what connects you to today's topic?
Sure. Well, thank you, Michelle, for having me. So John Caplis, I'm the CEO and founder of Pivotal Path, and I founded the business a little over 11 years ago, and we've grown to become what our clients have started calling us. So we'll take it as a trusted hedge fund industry expert. And today, on behalf of our clients who invest over $400 billion collectively in hedge funds, we are creating the most comprehensive set of hedge fund data, unbiased research, and accurate benchmarks for them. And so given that we cover over 3,000 hedge funds on behalf of these clients across 40 strategies, we tend to see a lot of trends as they're happening, both from the GP side and the LP side. And portable alpha is something that we have definitely seen just over the last 12 months really come back significantly and with some nuances here and some changes. So we're excited to share it with the rest of the community that I'm sure are hearing a lot about it. And we think that everyone should really be educated on pros and cons and all of the things that are available.
Thank you, John. I know I always enjoy trading industry color and trends with you and your team, and I'm glad we can do it with this great group we have today. Keith?
Yeah, absolutely. Thank you, Michelle. And thanks for putting a panel together and for those that have joined. I work at GCM Grosvenor, which is an alternative investment manager that's specialized in alternatives for more than 50 years now. Today, we manage approximately $80 billion in alternative investment strategies across absolute return strategies or hedge funds, private equity, infrastructure, real estate, and credit. I'm a managing director in our absolute return strategies business, and I've been with the firm for 14 years and in the hedge fund space for a little more than 20 years. At Grosvenor, we launched our first hedge fund program in 1971, which we're still managing today with a 53-year-old track record in the space. I would say as it relates to portable alpha, clients have engaged us in various ways over the years and decades. I'd say the most notable lately has been as it relates to our market neutral multi-portfolio manager hedge fund strategy that we call Belmont Harbor, which is an uncorrelated factor managed strategy focused on high idiosyncratic alpha through security selection, which lends itself well to packaging in a portable alpha manner, which we'll spend time on, of course, over the course of the webinar talking about what that means.
Thanks, Keith. I look forward to unpacking it. And I was going to say this, revisit, much like low-rise jeans makes me feel old, but that 50-year track record helps contextualize what really is the long term. Lauren?
Hi, thanks so much, Michelle, for having us. And thank you for joining us today. Lauren Sholder from Winton Capital. I'm responsible for business development in North America. Winton was founded in 97 by David Harding. He pioneered trend following back in the 80s and then founded Winton in 97. Today, we manage around $13 billion in assets broadly across two different types of strategies, a quant multi-strat and trend following CTAs. So for us, trend following CTAs have been a natural component of portable alpha. And I think we'll get into this because future strategies are so cash efficient. Our investors have been employing a portable alpha strategy almost unwittingly, not necessarily known by name, because you can do it pretty easily. So we've had a lot of experience with this, a lot of interesting conversations. And whether or not it's in vogue or not, it just sometimes makes sense because the strategies lend themselves so well to it.
That's such an important point. Thank you so much, Lauren. And Rodrigo?
Thank you for having me. Looking forward to this discussion. I am president, co-founder, and portfolio manager of Resolve Asset Management Global. We are a global firm. We have offices in Toronto and the Grand Cayman. We're an alternative asset management firm, and we focus on globally diversified systematic macro strategies, exclusively using futures contracts, so similar to Winton. from day one, the company was founded in 2015. We've been using Portable Alpha for investors. We manage just about $2 billion under management, and we run bespoke, separately managed accounts, private and public funds as well. The other business that we are running concurrently is called Return Stacked ETFs, also co-founder there. That's a business that's growing quite quickly. And yeah, so with that, looking forward to the discussion on expanding on these topics.
Excellent. And I think, we have quite the diversified panel here with different types of alpha engines. And then, also speaking to what's going on in the institutional marketplace, but also, this newer entrant of retail to the market. So let's get into it. Let's start definitions, because I know a lot of people use a lot of words and don't always mean the same things. So Keith, can you level set and just, define what portable alpha is?
Sure, happy to. I'll just provide some basic terms and get everyone on the same playing field, a little professor moment. Portable alpha is really a portfolio construction approach through which both a beta source and an alpha source are packaged together. The beta source is typically an exposure that an allocator has or wants in their portfolio. Often it's an equity index, a broad index like the S&P 500, MSCI equity, or Russell 2000, but it can also be betas in other asset classes. We know certainly of investors and allocators that are using fixed income as a beta source in their portable alpha construct as well, amongst others. The exposure is usually obtained through the use of futures or swaps to allow for partial funding and capital efficiency in the approach. The alpha component is then a strategy that produces alpha that is uncorrelated to the beta source. It's essential that the alpha strategy is actually uncorrelated, and even more helpful if it's one that's consistently uncorrelated to the beta portion. For packaging together, the alpha component is most frequently, and you'll hear it a lot in conversation, is most frequently in uncorrelated and liquid hedge fund strategy, but maybe not exclusively, but that is the most frequent adoption from the alpha component. The premise is really combining the beta and the uncorrelated alpha, that it can be a better solution or a good solution for allocators to outperform their benchmark, sometimes better than traditional long-only strategies can be, or at least as another means of approaching that way of outperformance versus a benchmark objective.
Wonderful. And before we get into really the details and how it's being implemented, I wanted to address the elephant in the room, right? This is not the industry's first rodeo with portable alpha. So I'd love, Rodrigo, if you can give us a bit of a history lesson of how you've seen it change and evolve, and sort of why it went out of vogue and then now why it's back.
Yeah, portable alpha has been around. In fact, PIMCO was one of the progenitors of the idea way back in, I think, 1987, where they decided to provide what they called structural alpha portfolios, mutual funds, and separately managed accounts, where they would give you 100% of their bond portfolio, and then they would buy an S&P 500 E-mini contract for another 100%, providing 2-to-1 exposure so that allocators can use that. So it's been around for decades and decades. And in fact, it became quite popular where by the end of 2008, the 50 largest pension plans, 25% of them were using some sort of portable alpha and loving it, right? And they were using hedge funds. So most of them were using hedge funds that were fairly illiquid and they thought were adding alpha. But sadly, what happened in 2008 was when liquidity dried up, when that equity component went down, and there were margin calls on the derivatives that they needed, and they needed to go to their alpha sources and say, hey, give me some of that money back as I need to rebalance. I need to meet those margin calls. They were met with gating in 2008. And to add insult to injury, the alpha they thought they had, which was supposed to be non-correlated traditional equity, they were mostly benefiting. If you look at the hedge fund industry, it's highly correlated to the S&P at the end of the day, right? It's not necessarily zero. And so the problem was that when traditional securities went down, a lot of these hedge funds also went down with the market, which is the number one, I think, lesson learned from 2008. And so when that happened, it was really not, you didn't want to talk about portable alpha. The fear that you were using leverage in order to get a double whammy in '08 was a big problem. And so people basically forgot about it. And we transitioned to a world of trying to use security selection in order to try to beat the benchmarks again. And a lot of that went towards private equity, private real estate, and so on. So since '08, a few of these institutions have learned the lessons and have been able to implement the portfolios in a much more thoughtful way where, I'm just going to show a chart here, just to kind of bring the concept home. Let me know if you guys can see my screen. So what ends up happening is there were three areas of risk here that I think the vast majority of people in investing in portable alpha have dealt with, right? So you have your index exposure, whether it's the S&P 500. Instead of buying it with cash, you would buy a derivative exposure for 5% of your cash, get that excess return. So you have a lot of free cash here to use. You have to use a little bit of that cash just for margin requirements to get exposure to that derivative. Institutions generally leave a little bit more safety buffer in case they need to fund that margin if they get a margin call. And whatever cash they have left aside from that safety buffer, they will allocate to the alpha source. Now, the 3 points of pain were some of the bank swaps. Instead of using kind of publicly traded futures contracts, some of the bank swaps, there was some counterparty risk there. So that was a big fear where banks may not have been able to provide the exposure that they promised. Alpha was not really alpha. It became quite correlated to the beta. That's another lesson learned. And then hedge funds gated redemption. So anybody doing portable alpha right now largely deals with all of these by most of the time creating multiple counterparties for the derivatives or going straight to the market in the future space. So that's kind of been dealt with. The safety buffer management has become, risk management is going to be top of the risk management tool for portable alpha. You have to have a team or consultants that can help you with that. And then importantly, the alpha source has to be liquid. It has to be fungible. And as risk increases, you should be able to rebalance easily. And so when you deal with those pain points, all of a sudden portable alpha becomes a really important tool in the toolbox. And there's been a handful of institutions that have used it very successfully, Delta Airlines being one of them, that took the risk in 2011 when they were underfunded and almost going bankrupt, using portable alpha. He called it, John Glidden called it his benchmark beating machine. And in 11 years, he's gone from the most underfunded pension to overfunded, using this concept, using liquid assets and using proper risk management consultants. So that's kind of the history. We're back into being able to talk about portable alpha now. I think there's excitement. Valuations are high. Yields are starting to go down again. We're going to have to look for alternatives. And this is one that is really compelling.
Thank you for that history lesson, Rodrigo. And going into that kind of last bucket that you had pointed out, the alpha engines, let's start there in terms of, just digging in about how they have improved and the types that are most prevalent now. So Lauren, starting with you, can you share a little bit more depth into the sources of alpha that Winton is looking at for these strategies?
Absolutely. I think it's really important to underline what's been said, that it's important the alpha is both lowly correlated, potentially negatively correlated, and absolutely diversifying. And because, Rodrigo, you're right, it should be somewhat liquid, we've tended to talk about our future strategy. Futures are very cash efficient. They have that natural embedded leverage in them because you just have to post the initial margin plus some buffer in order to shore up the entire strategy. And so why this happens with our investors naturally, they don't have a need for 100% funding of a future strategy. They can post 20, 30, 40% and have the extra cash there to invest in whatever they want. So we tend to talk with our investors in a portable alpha fashion of our future strategies. We have broadly two. We pioneered systematic trend. So that's naturally part of the conversation. And we also have been trading systematic macro strategies for the past 20 years. Those are signals that are non-trend, designed to be diversifying both to trend and to the exposures in an investor's portfolio, whether it's an equity or a bond. They're really to be diversifying as well. So when I have conversations with investors in this area, it's, do you want a pure trend strategy, or do you want to also add those systematic macro signals? Because trend is not guaranteed to do well in all environments. We know this. And that's why you would add systematic macro. But again, trend seems to be a very natural use here. It's very liquid. You use futures for it. It's had a history of doing phenomenally well when equities have been in sustained drawdown. We saw this in 2022. Equities and bonds were both down, and across the board, trend strategies did very well. I can't guarantee that every time equities are in drawdown, trend will do well. That's intellectually dishonest. It just so happens for the really big drawdowns in history that have been sustained, trend has done very well. But really, to underline that point as well, risk management is a crucial conversation to have with your manager, especially for this type of alpha conversation. Whether something that you're putting in an alpha bucket has been diversifying in history doesn't guarantee that that relationship will be stable going forward. So is your manager aware of that? We like to run our strategies not just with intense risk management, knowing that correlation relationships will change, knowing that volatility can spike on a dime, but also having a convexity awareness. Future strategies are often used for their diversifying properties. Is your manager structuring the fund so that it will continue to be diversifying going forward, or minimize the drawdowns when they turn around? Nothing is going to be positive forever. So those are all, and we'll get into this later, but when you're looking at alpha, yes, diversifying, lowly correlated, efficient, that's all really, really important to signal.
Thank you, Lauren. And Keith, I would say one of the biggest trends in hedge funds over the past many years has just been the huge, struggling to find the right adjective, huge growth of the multi-strat platforms, or the multi-manager platforms, I should say, even more so. So can you talk a little bit about, why you're looking at that approach for an alpha engine, and just really how this distillation of alpha has just become so much more precise over the years as the technology and sort of toolkit has evolved?
Yeah, agreed. And I think it's an important point. It's not unrelated that the growth of allocator adoption of multi-PM and the growth of interest in multi-PM, which has increased a lot in recent years, and the renewed growth of portable alpha, I think those trends are intertwined. And it goes a little bit to where Rodrigo was, which is, if you look at the kind of classic or most commonly applied hedge fund strategy, from many years ago, it was kind of tiger cub, long bias, long short, type of approach. There's alpha by good managers there, but there is also beta in that profile. And so, you need to be careful about the sensitivity you actually have. And I think as Rodrigo laid out many years ago, that approach, I think people underappreciated the beta component, even if there was also alpha associated with good managers in that strategy, in addition to the liquidity point that Rodrigo mentioned. So, our approach to multi-PM, focuses on hiring experienced specialist portfolio managers that have been very high producers of return on alpha for a long and successful career. And we hire them to trade directly on our balance sheet after we analyze their daily historical P&L, daily historical position files. And so what we can focus on is hiring PMs that have real skill in security selection and are not driving any of their returns of any consequence through other means like factor loadings, betas. We talk about the tiger cub issues I don't mean to pick on the tiger cubs, but from that style of investing many years ago, where you have some beta, but even more sophisticated today, which is consistent with how we manage our program, is focused on the next level of betas, factor loadings and other sensitivities, because you can have hidden betas that are not broad market sensitivity. You need to be conscious of those as well. So when we hire our PMs, we hire them to trade directly on our portfolio's balance sheet. We give them specific risk limits that they have to comply with every day, that we test every day. They can only trade in markets and security types that we authorize. We control and direct all their counterparty relationships, including the prime brokerage relationship, so we can control even beyond, the contractual relationships. We analyze all their specific positions every day through our risk engine, so we can hedge out any unwanted sensitivities. And so therefore, through this strategy, what we deliver is fundamental alpha through predominantly idiosyncratic risk, meaning fundamental security selection skill, not market beta, not sector bets, not country tilts, not factor risk, And so that type of strategy lends itself well to portable alpha because one, it's consistently uncorrelated because it's managed to be so day in and day out. Two is, through multi PM versus as opposed to single PM, you get a more stable and lower ball profile that packages well with a beta source because that greater confidence and robustness of outcome packages quite well. So again, I think it's not an independent trend. It's an experience that we have and one that we hear from investors. Frankly, the reason we talk to investors about portable alpha is because we meet them where they are. They come to us. It's more reverse inquiry. You have an alpha engine. The way we want to think about multi-PM and package multi-PM is in a portable alpha construct. And so that's a trend. I think that those are related in how it's moved into the marketplace.
That's great. And I think it's helpful to hear from two very different firms and strategies, really how this can apply in the structure. And John, let's get a little bit more granular in terms of, the interest you're seeing from institutional investors, right? We hear about it all the time. Kind of what's the activity? Why are they attracted to this strategy? Tell us more.
Sure. Well, thanks, Michelle. A couple of things that I would say to that. I mean, one is that certainly portable alpha is making its way back into the institutional investor conversation and portfolios over the last decade. So it's not just, in the last year or 18 months. Certainly it's gained traction over the last 12 months in particular. There's a couple of reasons which, some of them are obvious and maybe some of them are less intuitive. So one of them is just the fact that hedge funds have performed quite well over the last number of years and just as in general. And our composite index since 2020, which seems like a lifetime ago, has generated close to 8% annualized performance. It's generated a significant amount of that in the form of alpha in relative to the S&P, which whether that's the right barometer or not, it's certainly one that people use. It's something that has had 1/3 of the volatility, 1/4 of the drawdown, right? So when you kind of think about risk-adjusted returns, alpha generation, all of those things, hedge funds have done quite well. So that's one of the reasons why they have been back in focus. And then in addition to that, historically, every single institutional investor also has their own set of constituents that they have to essentially sway to invest in hedge funds. And so one of the things that we've seen, and I'll just give an example without naming names, a relatively large hedge fund that their allocation to hedge funds is roughly 5%, right? That's what their book looks like. However, if you then incorporate what they have in portable alpha strategies within hedge funds, it's actually about 30% of their capital, right? So, there's this concept that one could say it's a stealth way of smuggling hedge funds into your portfolio. And really the way it's working is it's expanding the use of hedge funds beyond just this kind of simple alts bucket where it used to be, oh, well, this is the amount I have allocated to hedge funds. A hedge fund bucket, this catch-all phrase, it's not really how investors are looking at the equation today, right? They're looking at a lot of the equity portfolios that we talked about, whether if they have, beta to the equity markets, these are extensions or even replacements of their equity strategies. Same thing in fixed income. And so what we're seeing is just, different ways of incorporating hedge funds into portfolios. And also given the liquidity benefits. And then when you look at it on a relative basis to private equity and other alts that have had struggles over the last number of years and the lack of liquidity, the lack of distributions, that liquidity premium is coming back in vogue as well. So we're seeing interest from obviously the LP side, but I think the biggest difference this time around is the fact that and Keith, and Lauren both discussed this. It's not that it hasn't been done in the past, maybe not necessarily with this specific term applied to it, but it's the fact that the managers, the GPs, are coming up with bespoke solutions. So it used to be back, many years ago before the global financial crisis, this opportunity, and Rodrigo alluded to this as well, was really only available for institutional investors that were sophisticated, yes, but also had significant resources to put these strategies together to really be able to distill alpha from beta, to set up the infrastructure. And today, even before kind of getting to the retail market, at least for the institutional investors, they're now looking towards the managers who are seeing this as a way to create more bespoke partnerships with their investors, which I think is a very good thing in general. And these bespoke solutions that they're creating are also now, once they do it one time, the managers are starting to see that, wow, this is actually something that we can offer to many clients and many investors. And so again, it's democratizing, and at least in terms of institutional investors, large and small, being able to access the same types of portfolio benefits that historically wasn't necessarily available to them.
No, I think that's fascinating. And as someone whose job is to represent the hedge fund industry, it's fantastic to see them being such utility players across a portfolio. And, really that's being recognized again. Rodrigo, before we come back to Keith and Lauren to talk about this theme of productization, tell us, what made you think about this in a retail solution? And how have you rebranded this concept for a wider audience?
Yeah, I think what had happened is back in 2020, 2021, we were doing okay with institutions, with single family offices. We had some public products where we were trying to ask investors to make room in their portfolios for these alternatives that we were running. And we were just banging our heads against the wall because we had gone through a period where in equities, especially U.S. equities, dominated the return stream of any single asset class, and bonds had done pretty well as well. And so when you're competing for that space, investors are looking at you saying, yeah, no, I get it. You have zero correlation. Yeah, I get it. You have quote unquote alpha, but the S&P's annualized at 10. You're annualizing at 5. Like, there's no way. I'm not going to make room in my portfolio. And at that point, I said, look, we need to yes and this problem, right? We need to find a way to express it. How about you get to keep your 60-40, and we're going to stack that excess alpha on top. And we have to rebrand the name. We wrote a paper in 2021 called Return Stacking, Strategies for Overcoming a Low Return Environment. And if you remember, mid 2021, rates were nearly zero. Valuations were the highest they'd been since the bubble. And people were reaching for yield, right? They were going at getting high yield products, private equity, private credit, like levered plays in the same equity. And the solution here was like, how do we reframe? How do we make it more accessible? Nobody knows what portable alpha is. Nobody knows what alpha is. And this is where the idea of renaming an old idea into return stack the retail space. And the moment we started testing that white paper went viral. The moment we started testing that, we realized, okay, this is an important name change. Number one, the SEC came out with very clear guidelines for the industry for the first time ever on the proper use of derivatives within ETFs and mutual funds, which then UCITS and Canadian regulatory environment has also started to adopt. And so when we got clear guidelines as to how to use derivatives within ETFs and mutual funds, we were then able to provide a highly professionally run derivatives book, because the reality is prior to that, most mid-sized fund foundations and institutions simply did not have the expertise to have a derivatives desk. And so, as John alluded to, managers like us started creating prepackaged solutions. And really that helps I'm just going to share my screen real quick. That helps in the funding problem. Can you guys see my screen?
No, we can. Yep.
Okay. What this shows is a wide variety of alpha strategies over that 20-year period. And what you'll note is that none of them do better than 10%, which is what the S&P did during that period, right? So this concept of, hey, your alternatives should be in this thing that's going to make you less, which just wasn't palatable. And that's why everybody went private equity, because you could get better returns because you were levering beta, right? So what portable alpha does, it solves the funding problem, right? We were seeing people for probably all of our careers in the alternative space, we've been saying to people, look, make 20% of room in your portfolio, sell 10% of your bonds, sell 10% of your equities, and make this 20%. And over that 2-decade period, 20% is grossly underperformed the 60-40. Nobody wanted that, right? The benefit of portable alpha is that it solves the funding problem, allowing investors to use, to keep their favorite toys, while stacking that excess return on top. And of course, we've talked about what's important. So in essence, what ends up happening is any return of those alternative strategies above cash, it may be 200 basis points, 400 basis points, 600 basis points. that used to be super unpalatable all of a sudden become Lego blocks that you get to stack on top. When you add it up, you end up providing investors with a different way to outperform a benchmark, right? And you could choose your stacks. This is the beautiful thing about portable alpha. A lot of people investing, we like to think it's a one-stop shop. There's a lot of values invested in what you believe in. Do you believe in trend following? Do you believe in carry strategies? I believe gold and systematic macro, market neutral. Every client's going to have a different view. And so the goal here is to democratize and provide people the Lego blocks so that they can make their own decisions as to what to stack on top and that prepackaged solution being managed. Right. So I think the language has changed. I think accessibility, the clarity from the regulators, and then the simple story of like, what do you have more confidence in the future? Do you have more confidence in finding a active security selection manager that's going to outperform a benchmark? By the way, this 1.17 is what the outperformance has been of the top decile managers in the last 10 years, right? And the chances that you're going to be able to capture this in the next 10 years by buying the same manager is probably a rough thing. Or do you have confidence in a bunch of diversified alpha streams that you can stack on top? And I would say that the latter argument is winning the day. And now individuals are talking about it. They're on Reddit. They're getting it. So it's been pretty exciting to watch. And I think it probably is going to warrant a completely new category in Morningstar and whatnot, so that those prepackaged managers, which there are a lot of, we'll start being able to source them and provide better portfolio construction in the future.
That's fascinating. Thank you so much for that and for the visual as well. Bringing it back to the institutional side. First, Keith, I have a quick audience question building on your prior comments. Keith was talking about analyzing stocks daily. How often is a portfolio rebalanced? Is it daily or intraday, monthly? Do you have any comments on that?
I guess there's for our strategies in particular, and then I guess in a portable alpha construct as well. So within our strategy, I mean, our portfolio managers are trading daily, right? I mean, they're fundamental PMs, but there's adjustments in their portfolio on a daily basis, certainly. In terms of the risk budget we give to our PMs, it tends to be more structural. So putting aside capital flows from investor flows, which of course mean, adjustment to risk targets for PMs, it's more structural. So it tends to be kind of plus or minus quarterly adjustments outside of other strategic changes. But best case scenario is less is more. Let your PMs do what they do well and risk manage the portfolio around it. In terms of the portfolio, when it's structured in a portable alpha combination, we'll get into some of the structure, I think. But in terms of how there's excess liquidity, and we've talked about a little bit around whether there's cash for unencumbered management of variation margin or other types of credit facilities to adjust those. Those are used more typically for settling of modest daily variation margin needs. And so, changes, the best case scenario is to, again, not interrupt your PMs from what they're doing in their alpha production. And so using other structural benefits to make those modest adjustments on a day in and day out basis as needed. And that's typically how we go about it.
Thank you. And thank you, questioner. So back to the original question, how are you seeing, are more of your clients looking at it from a bespoke perspective and they themselves are managing the portable alpha product? Are you productizing it? What does that look like? And what are some of the pros and cons?
Yeah, there's definitely both. I would say
all of the above.
Yeah, there's definitely both. In our, we're not completely agnostic to structure, but we are generally agnostic to if an investor wants to engage us for helping them structure the portable alpha, or if they want to do it on their own books. It's, I think, once you decide as an allocator you want to participate in portable alpha, in a way, there's definitely different ways to go about it. I think, it's been referenced a little bit, but many institutions over the longer term have chosen to implement it themselves. And so even from the post global financial crisis period to the more recent period, when it sounds like, people are talking about portable alpha a lot more, there were a lot more institutions still participating in that way. They just weren't as vocal about it. So they were using the uncorrelated alpha source and then packaging on their end in a way that, whether it was structural or just in the way that they thought about portfolio construction. In the case of an institution doing it where they're effectively directly investing in a hedge fund or hedge fund portfolio, and then trading the beta exposure themselves. It's typically been the most common approach. And I think it's predominantly because there just weren't a lot of packaged solutions from managers being provided. So if you liked an alpha source or a manager and you wanted to implement in that way, you're predominantly had to go it alone. As it was referenced, there's definitely increasingly more managers providing prepackaged portable alpha offerings where they combine the alpha and beta themselves. It's still relatively modest, but growing. Overall, I think, it's really been in response to investor interest and a realization that that's just how many allocators want an easier access solution, kind of simple subscription, and it all is taken care of and managed for them in addition to the rest of the strategy that's managed. When managers provide the single solution, I think there's still some different ways to structure within that. It can be an entirely separate fund that's managed as a totally, separate from the existing fund. It can be a share class where portable alpha is an offering within a commingled existing fund with other non-portable alpha investors. In that case, it's typically kept by the manager to be a very small percentage of the total assets of the fund. And then a third approach is we see, and we've done, where you use a feeder fund that effectively is walled off from the non-portable alpha investors, but efficiently access the same already managed alpha source. I mean, there's pros and cons to the different approaches. It doesn't need to be one size fits all for each allocator by any stretch. I think, when the manager structures the solution, when we think about beta management, it's easier for them, for the investor, and all they have to do is subscribe. And the manager often has a better understanding day in and day out about what their beta profile is, what their other systematic sensitivities are. And so they can manage it more tightly to being beta 1 to whatever the reference beta profile is targeted. But an institution, if they take that on themselves and do it internally, that alpha strategy is not the only source of any potential systematic risk, right? There are obviously other exposures in their broader asset allocation in their portfolio. So an institution can dial up or down their beta profile in conjunction with other betas that they're picking up across their broader portfolio. So it doesn't need to be done in isolation necessarily. And that can be a benefit for an institution that has that capability. There's other considerations. Clearly there's cost of execution. Sometimes the manager, sometimes the institution has more efficient means. And then all the challenges of just putting it together and the resources around it. So there's different ways to go about it. It doesn't need to be one size fits all. I think it's nice. It's a nice evolution or, kind of progression in the marketplace that there are more managers providing this type of solution in different structures, institutional and retail for Rodrigo. And that's a nice evolution, but it really can be different ways that investors can access it.
And Lauren, what are you seeing from your vantage point in terms of the buy versus build?
So similar to what Keith mentioned, there are two ways to really think about this: the internal management of that beta component or the external. You're absolutely right. For a long time, when portable alpha kind of went away as a label, a lot of it was done in-house. But a lot of institutions just don't want that responsibility to rebalance, to figure out what that exposure looks like between the two. And so for us, the conversation is around how do we package it together, either in a managed account or a fund of one, and we take on an agreement with the investor. How often are we rebalancing the exposures every day as well? So these things are moving target. What do we want to package together as a futures strategy shop? Futures management and trading is very simple, very straightforward for us. So accessing that beta through a future strategy makes it really easy. You're still left with some cash even after you incorporate both beta and alpha. And then you talk about what that looks like in terms of the cash management strategy as well. But we've seen both. We've seen both the management internally of beta by institutions and those that are less comfortable with that coming to us, and we package it all together with agreed upon terms.
Thank you. And of course, while we discussed how some of the risks are more tightly managed this time around, nothing is without risk. So, John, can you talk about some of the key risks running a portable alpha strategy and how both allocators and managers are mitigating them?
Yeah, of course. And I think what Lauren said is one of the key components of a successful relationship. I think it has more to do with creating transparency around the entire process, right? Clearly established and agreed upon objectives. Obviously the benchmark is ultimate importance. But what is a successful execution, right? I mean, even when we talk about simple things, we were defining some of the terms early on. When we talk about beta, when we talk about correlation, we may all agree that something like zero correlation is a really good thing, right? And if you're generating positive returns with zero correlation, that's alpha. But over what time horizon, right? And so, especially when you think about managed futures, and I can say this because I come from the managed futures world, that was my prior career. But managed futures tends to have zero correlation to equity markets over a market cycle, but it's typically a directional strategy. So at any point in time, it may have positive beta or negative beta, right? So the idea is you really have to have a conversation. That's why this partnership aspect is so key, that you really have to agree on, again, not only kind of all the inputs, but what are the outputs and how do you measure them and how do you define success? And, if you're looking at kind of getting back to that managed futures example, typically when there's a sudden shock to the system and trends have been moving the other way, they're going to move in the same direction when that sudden shock occurs. It happened in March of 2020. I think it happened in 2007. That doesn't mean that over the course of time, that when markets continue to go down, that it won't generate alpha and uncorrelated returns, but it means that, again, you have to agree upon that time frame. So I think that's one of the key issues in terms of making sure we don't see what happened in 2008 happen again. And then I think the other thing that's, still really important for both sides to remember, and again, you can measure this and hold the manager accountable, but alpha can be positive and alpha can be negative, right? And so especially when you're creating these stacked returns, you're creating leverage. You're adding leverage to your portfolio. Maybe a very efficient way of adding leverage, maybe a smart way of adding leverage, but you're ultimately making a bet that these uncorrelated returns are going to be positive. And so if they are negative, that's going to have significantly negative effects on your portfolio. So, the risks are still the same. Again, I think today investors are much more astute at kind of what they want, and managers are also, much better at understanding what they want and making sure that those are agreed upon. The last thing I would say, and Keith, you mentioned this earlier as well, and I think Lauren, you touched upon this, but in terms of, who's doing or who's executing the strategy, I mean, I think theoretically, there's always going to be a lag if, whether it's in a separate account and an investor is receiving a set of returns, and then yes, they have flexibility to maybe hedge out returns at their portfolio level as opposed to at a fund level or strategy level. But it's always going to happen with a lag. Even if it's a separate account, they're going to see the returns, they're going to see the exposures, and then they're going to have to adjust accordingly in a dynamic way. Whereas Keith, as you mentioned, you can manage that almost ahead of time, and a manager can be much more efficient. Again, if they're doing it well in terms of making sure that beta, again, over whatever time frame is agreed upon, always stays at zero and doesn't have to be hedged out after the fact.
No, those are great points. And Rodrigo, let's just dive into some areas of risk. We spoke about when things fell apart in 2008, which was, of course, a very sharp market drawdown. Sorry. So how does this strategy tend to react in periods of market drawdowns?
Well, it depends on the strategy. So, there's a couple of ways to think about this. And Jason Josefiak of Makita, he's no longer there, but he put together an interesting framework in terms of alpha. And, you have 3 layers, which is first responders, second responders, third responders. And I think a lot of what Keith has been discussing has been kind of a third responder type of approach, which means what is first responders is if the S&P 500 or your beta goes down aggressively, they're going to immediately provide offset. These are the tail hedging strategies, the black swan protection protocols, and the long volatility type strategies. The second layer, kind of to what John was alluding to, is more of the trend following systematic macro strategies, more trend following systematic macro, where if the trends have been in line with equities and there is an abrupt shock, they're not going to be the first responders. They're going to take a week or so to get out and start making money. 2020 is an example of that. First week down, then flatlined, then started providing value near the tail end of that drop. So understanding the time frame for those and what you want to do, what you want that alpha to do for your portfolio is super crucial. And I think the third responders are just zero correlation, consistent zero correlation, where we're not taking directional bets at any time. And when you have that area properly created and you create a multi-manager approach, the goal there is to have a completely idiosyncratic equity line that tends to make money over time, whether it's a market crash or not. It doesn't mean that at any given day that third responder isn't going to lose at the same time as equities, but it's not because of the equities that they're losing. It's just the random nature of a completely idiosyncratic return stream. And if you put these together, you get a Sharpe ratio of 1, over a period of months, you should have an upward sloping equity line most of the time, right? So the third ones are not necessarily there to fill in the gap in case of an emergency, but if done correctly, it won't hurt you either, right? And so this is the way I think, I love the framework. I think when you think about portable alpha, you should think about what your values are, what you need it to do for you. And there's a wide variety of people that will only do trend because they just want that protection over a full bear market. There are some people just want tail, and there are people that just want to have that froth, that excess alpha most years, which is what you get with a diversified third responder portfolio that you may not get from a trend follower where it can go through a lot of years of choppiness, but then you get all of those returns when things hit the fan. So I think that's an interesting way of thinking about risk and portable alpha and the different buckets that you can think of. Obviously, I'm a big fan of the combination of all.
That's a good segue to Lauren. What questions should investors be asking, and are they asking the right ones?
Sure. I think I want to first start with a higher level conversation that we've danced around in the past 50 minutes or so, which is the asset allocation. We're all used to a strategic asset allocation that has asset class labels and siloed information, maybe misalignment of incentives. Why that's relevant to portable alpha is because it doesn't, and I think, John, you mentioned this, it doesn't neatly fit within any of these labels. This is something I've had in conversation with investors for a very, very long time, preceding my time at Winton. Where does this fit? Is this a diversifier, absolute return? Is this a hedge fund strategy? Is this an equity premium? And I think it requires some level of progressive thinking by the organization, maybe to break down a lot of those barriers that exist today, because it doesn't neatly fit in a bucket. And if you look at more of the holistic approach we've been seeing in portfolios, where do you want to spend your risk is the right question. And what type of risk are you spending your budget on? And what are you trying to accomplish with that? And the good news is that if you can approach the portfolio in that holistic manner, you can see some real opportunities for risk-adjusted return. But going back to portable alpha, it requires, again, that alpha is diversifying consistently over time. And Rodrigo, to your point, absolutely, you don't want to be in pain for too long before it gets back to diversifying. And that requires a level of convexity awareness, but also risk management. It's kind of what I like to say every single meeting I have, risk management. It's so crucial. So the first important question we've been talking about, I think all of us, how diversifying, how lowly correlated is your alpha to your beta? And I brought a slide along with me, not to hawk my own book, but we love CTAs because what we've seen, this is the past 15 years, if you look at these HFR strategies over time, the only strategies amongst the only strategies that have been negatively correlated to 60-40 have been CTAs. Yes, in a shorter period of time when there's a sudden reversal, you will see some correlation. On the positive side, it is a directional strategy, but over time, within market cycles, over market cycles, CTAs tend to offer you that diversifying opportunity. And what is also important to recognize, though, when you're asking about this type of strategy, is the manager aware of the management required, the risk management required to keep that diversification within the strategy so that you're not just adding to returns while increasing linearly your chances for drawdown. The point of a diversifying strategy is to reduce the volatility, to add diversification, but that goes away if you're asleep at the wheel. We saw this in 2023 of March last year, not being aware that correlations can change, not being aware that relationships, volatility can change, really does ruin the diversification properties of even a strategy like the CTAs. So that for us, and thank you, Crystal, for showing that, that really is among the most important conversations that I have when we decide what type of alpha strategy to put in this context. is it diversifying? Is it consistently diversifying? Is your manager paying attention to what can really get in the way of that diversification going forward? Because you don't just want to double your risk. Again, it is a leverage strategy, but that doesn't mean you're simply levering your beta. That's not what anyone is looking for in this type of strategy.
No, that's super helpful. And thank you for that visual. Do you have some more questions to round us out? But I would be remiss if I didn't remind the audience that they are allowed to also ask some of their own. But while you put your thinking caps on, Keith, we've alluded to this at a few points, talked about our friends on the private market side. That's also been such a huge shift since 2008. So are liquid hedge funds the only alpha engines? What role really do private market alternatives, what role can they play?
It's a good question. It's a tough question. I think
That's why I saved it for you.
I appreciate it. Hedge funds they don't have to be the only alpha engine. They are definitely the most commonly used. And hedge fund alternative, liquid alternative strategies like we talked about. I think regarding private markets, there's certainly discussions around how to utilize private market strategies in a similar construct in the same way that we've talked about, John said, smuggling in alternative hedge fund strategies into long-only parts of portfolios. Naturally, it's a natural extension for allocators, institutions to start thinking, well, can I do something similar in a private markets construct where I maybe want more exposure there than I have in some cases. I think it's inherently more difficult in private markets. We've laid out in different parts of the conversation some of the reasons that won't shock anyone why, but I think it's, less liquid strategies are just harder to make adjustments in the alpha beta package day in and day out, or, over as needed ongoing. I think in line with that, it would definitely require holding excess cash to manage the variation margin, because in a private market strategy, you can't easily access for liquidity. And so that creates some inefficiency of cash drag, which would dilute the overall objective or profile. And then I think the third one is, strategies that are less frequently or not marked to market overall, the calculation of what the strategy's actual beta profile is versus, actual versus realized, it's just difficult to estimate and manage around. You could be very meaningfully over or undershooting, the beta targets that you have if you're trying to get to a beta 1. And so it's just inherently more difficult structurally than a lot of what we're talking about. Liquidity is a big one. It's just a big one, that the more liquid the strategy, the better for the implementation. The more, as we've referenced, the more consistently your profile to be uncorrelated, the better the outcome. So, those lend themselves more to liquid alt strategies, certainly, than to private market strategies. But I don't want to completely push it aside, because when we talk about private strategies, there's a lot of different ways. The private credit market certainly is maturing in a pretty meaningful way. And so, often I think in this types of conversation, you might just blanketly think about private equity, a very kind of classically. The reality is, whether it's infrastructure or private credit and certain types of uncorrelated private credit strategies, there could be means where it could be okay and potentially appropriate, but definitely less commonly done.
Keith, between us friends, do you consider private equity and private infrastructure to be actual alpha, or more akin to levered beta, or maybe a structural alpha? Like, what do you see alpha there?
There's definitely alpha there. But I think a lot like our conversation of the pre-financial crisis hedge fund community, you have, it's not as a disaggregation entirely where you can have more pure alpha engines and more pure beta engines. There is a combination. So there's alpha, and there's definitely value proposition from talented practitioners in the space, but you need to be careful about the fact that you're not totally disaggregating from other market forces and systematic risks in the portfolio often as well.
It'll be interesting to see how that evolves, and if the same forces that shape hedge funds might be brought to bear in private markets. We are almost out of time, so I'd love to bring this conversation to a conclusion by giving the last word to John. So, this isn't the only trend. We've also seen a renewed interest in separately managed accounts. In fact, we are hosting a webinar on that on Monday for anyone interested. And then also a blast from my past, I'm hearing a lot more about short extension products, these 130/30 or, 7-year number, from more of those, directionally stock picking managers. So kind of what's the tie that binds all of these? Why are they all coming, John?
Yeah, I mean, it's a great question. I think that, these topics that are making waves this year are really part of a broader evolution of hedge funds. And, whether it's custom solutions that we've talked about, portable alpha, hurdle rates, fee negotiations, co-investment opportunities, separate accounts, we really see it as all about increasing demand for transparency and control from the investor standpoint. But really so that allocators can better understand exactly what they're getting in return for the fees they're paying and how it specifically benefits their portfolio. And so, separate accounts have been a huge trend. Again, something that have been around, especially in the CTA managed futures world, right? We've seen these since the 80s. And, now they are seemingly back in vogue again. And, yes, they provide additional levels of transparency and control. They allow for notional funding or efficient use of capital. They essentially, embed in a hurdle rate because you can do whatever you want with that cash. You can invest, in other, cash instruments. And so what it does is, all of these things, they enable at least the ability for, again, managers to the allocators to have that control, to be able to dynamically hedge if they need to, should exposures exceed certain thresholds. And I think all of these things, they're really a positive and a big positive for the hedge fund industry, right? I think the fact that we're now creating these partnerships, which are two-way streets, again, between GPs and LPs, I think it's going to extend the life of these relationships between the two. And it really just demonstrates a maturation of the industry. And I think it's going to create a path for continued growth. And so all of those things that you mentioned, and on the retail side as well, the industry is changing, it's maturing, it's institutionalizing, and that is going to really help the industry grow going forward.
Excellent. Well, on that note, thank you, John, for helping me to convene today's discussion. Really appreciate your help and your colleagues. A huge thank you to Lauren, Rodrigo, and Keith for sharing your expertise, lessons learned, some great visuals. All of you in the audience for your time. It really is the most precious commodity you have. So, thank you for giving us an hour on your Friday in advance. Thank you to anyone watching this on replay. And, maybe it's less than an hour because you like to watch things at 1.5 speed. But anyway, really appreciate it. I learned a lot today, and have a great rest of your Friday.
Thank you, Michelle.
Thank you.
Thank you.
Bye.